My name is Tad Schatz. I'm one of the partners here at Baum Smith and Clemens. Um, all right, here we go. All right, so I'm one of the partners here at Baum Smith and Clemens. I'll be presenting the first half of the presentation today, and then our tax manager Jason Paterka will take over and handle the back half of the presentation. I know we're on Zoom here, and I know people will have questions. Feel free to chime in if you have any questions or use the chat. We'll try to, Mike and Jason will be monitoring the chat, and we'll try to answer as many questions as we can during the presentation, and then we'll take some time at the end to button things up and answer anything that we weren't able to answer during our presentation here. So our first slide here is just our contact information. I know a lot of you on this call are our clients, so you have other contacts here at the firm besides Jason and myself. But here's the way to reach us: email, phone, and we're going to dive into things. So our agenda for the day, we're obviously going to cover the new tax law, the One Big Beautiful Bill Act. I probably won't be saying One Big Beautiful Bill Act all the time. I'm just going to be saying new tax law. It's a lot easier than the tongue twister there. So we're going to start with a little bit of an overview of that. We're going to go through some general planning strategies, some individual provisions, some long-term capital gain planning. And then the back half of the presentation, we're going to go over some of the new laws associated with businesses, some changes in the clean energy guidance, the timeline of provisions, and then we'll go through any questions we weren't able to answer as we are going through here. So we will get things kicked off. So on July 4th this past year, I'm sure everyone is aware that the Big Beautiful Bill Act passed. What basically was going to happen at the end of 2025 this year was that everything was going to revert back to what it was, and we call it sunset, what it was in 2017. So in 2018, the Tax Cuts and Jobs Act came into play. And one of the big changes of the new tax law that just passed on July 4th is it made a good majority of the regulations that were in place permanent. And obviously, when we say permanent, it doesn't mean permanent. It just means permanent means until someone changes it. They added some new temporary deductions, and they are starting to phase out the energy credits. Jason's going to touch on the energy credits, but phasing out those energy credits was a big reconciliation item on how they funded all this. So we're going to just jump right to it. So we're going to go over some general tax planning strategies throughout our meeting. And we're just trying to create awareness. We don't expect everyone to know the nuts and bolts of everything we're trying to cover this morning, but just kind of note things as you go along, just discussion topics for you and your accountant when you're doing your year-end planning and future planning. So our goal here is just to kind of raise awareness and get people thinking about different planning strategies and things they might want to implement. So we'll talk throughout the morning about timing discretionary income and deductions, multi-year bracket smoothing, stacking provisions to maximize tax savings, eliminating tax strategies around that, activities that you might have that we're able to restructure to take advantage of the laws that are in place, deduction order, intergenerational planning, which is a big topic these days, state situs and nexus planning. Pretty much ever since COVID hit and people started working remote and people are doing business or have employees in other states, this has become a real hot topic. And it's something to consider if you have people working in other states for you, or you're doing business in those states. So that's a big topic that we're going to cover. And then tax and penalty exposure mitigation. This is more towards geared around making sure your federal withholding's up to date. You're paying estimates to basically avoid underpayment penalties and interest. With the way interest rates are going, they're pretty high with the IRS right now. They weren't a couple of years ago, so it wasn't as big of a deal. But if you can avoid it, it's a good plan to do so. So we'll touch on a little bit of all these topics throughout the morning. So we're just going to dive right in. So So under the Tax Cuts and Jobs Act, the rates were lowered to the 10, 12, all the way up through the 37% bracket. The big beautiful bill, the new tax law made those rates permanent. And those rates are very favorable compared. They're the lowest they've ever been. So from a tax planning standpoint, it actually is a good time to, trigger income and maybe pay tax in some different planning strategies like Roth conversions or something along the lines of that, because the brackets are a lot wider and a lot more favorable than what they had been. The standard deduction, it was an increased amount in the Tax Cuts and Jobs Act. They kept it basically double of what it used to be. So for 25, we have our single, our head of household, and our joint standard deduction rates. So when we say standard deduction, you have two options on your tax return. You either itemize or you take the standard deduction. Lately, most people have been taking the standard deduction because it basically doubled from what it had been. And the real estate tax and state and local income tax was capped at $10,000. So not a whole lot of people had enough deductions to itemize. So they were taking the standard deduction. So we'll get into different strategies about bunching deductions so you can itemize and take advantage of that, as we move forward. So here's just a quick look at the different tax brackets. We start with single, head of household, married joint, and married filing separately. So you can really see that, if you're married filing joint, you don't hit the top tax bracket until $750,000 of income. I'm just rounding numbers here. Just to keep things in perspective, if the tax law were to sunset and nothing did happen this past year, and we were going to go back to the pre-2018 rates, the top tax bracket was 39.6%, and you got to that at a roughly $400,000 of income. So it's basically half of what it was now. So you can see if things did sunset, they would have gotten ugly for a whole lot of people with increase in taxes and whatnot. So some just a couple individual provisions that you can think about as you're talking with your accountant, talking with your financial planners, as to what you can do, to mitigate taxes, to save tax, to eliminate tax. We'll just go through just a couple here. Deduction advancement and deferment. Charitable bunching is a big strategy a lot of people use because the itemized deduction has been sort of phased out with the increased standard deduction. Clients will, for example, in 25, let's just say I wanted to donate $10,000 to my church. So I would do that in January of 25. And then for 26, I wanted to donate another 10,000. I would make that contribution in December so I can bunch my contributions for 25 and 26 and be able to itemize. And then I would skip a year and then do it again. So there's different strategies around bunching with the charitable contributions that, it's just a topic to explore if you're charitably inclined and you do give away, a good chunk of money each year and you're not able to itemize. We'll get into some other strategies a little bit later on in the presentation. Income deferment, retirement plan contributions, especially for higher income individuals. We can't stress this enough, maxing out your 401ks, if you have the ability to make deductible IRA contributions, put away what you can and defer as much tax as you can to future years. Income advancement, with the way the brackets are right now, Roth conversions have become a pretty big topic that we're discussing with our clients pretty much on an annual basis, really. Taking advantage of the 22 and the 24% brackets has been a nice opportunity for clients to convert, some of their regular 401ks or IRAs to Roth. Ultimately, being able to have a tax defer or a tax-free growth portfolio, shrink your qualified accounts that are taxable, and ultimately reduce your estate. So it's a good planning conversation. Good years to think about Roth IRA conversions with the delay in the RMD. Right now, the RMD, when you're required to take money out of your IRAs or 401ks, it's now 73. For some that are younger, it's going to be 75 years old. A lot of people are are retiring many years before they hit these years, the RMD years. So what a nice strategy is you can really depict what your income is going to be. You don't have to take money out of these accounts. You're in a lot lower of a tax bracket because you're not taking these RMDs. So a nice strategy is, utilizing these Roth conversions in what we call your gap years, the years between when you retire and you have to take out your RMDs. The stacking strategy, a lot of times you want to couple big deductions with big income events to offset each other. So a Roth conversion in the same year, you make a big contribution. Lost harvesting is a big opportunity these days with, the fluctuations in the market. Qualified charitable distribution from your IRA with medical expenses. The qualified charitable distribution reduces your AGI, and we'll get into this a little bit further, which by reducing your AGI, you're able to then maybe qualify for a medical deduction. I always say, though, I wouldn't rely on medical deductions because something usually bad has to happen. And we don't wish that on anybody to be able to claim a medical deduction. But there are large opportunities, especially with older folks who are planning on going into something more or less like a retirement community where they have big upfront fees. Oftentimes, a lot of those fees are able to be claimed as a medical deduction. So a nice strategy is to then maybe trigger some income or do a qualified charitable distribution because your AGI is lower and you're able to utilize more of that medical deduction and capitalize on that strategic plan. Tax elimination strategies. These are the most common ones. Your Roth IRAs, your Roth 401ks. It's the ability to grow money tax free. Your 529 contributions, for kids going to college, and now that expanded to K through 12 too. So a lot of different opportunities. HSA are a pretty common one as well. So if you're able to contribute to your HSA, we would recommend doing so because the money grows. An HSA is basically a medical IRA. It'll grow tax free. People can inherit it as long as they use it for medical purposes. You don't pay any tax on money coming out of those. And penalty mitigation, which we touched on briefly, just making sure you have adequate withholding and your estimates are paid in. So you're not getting charged penalty and interest for not having the correct amount of tax paid in. I know we all don't enjoy cutting checks to the IRS or the state or, the pain in the rear end local governments, but if you're going to owe tax, you want to make sure you have enough paid in so you're at least not paying penalty and interest. All right, so this was a new change in the new tax law that just passed this past year. The state and local income tax deduction was capped at $10,000. They now expanded it to $40,000. It'll be indexed for inflation annually. The inflation rate of 1% is nothing to write home about, but at least it's a little bit of an increase each year. If you do make over $500,000, your deduction starts to get reduced, but it won't go below $10,000. And then in the year 2030, it reverts back to the $10,000 limit. So it's constantly a moving target for the next couple of years. It'll go up and then it's going to revert back to $10,000. So we'll have but if I could tell you what the tax law was going to be in 2030, I wouldn't be here giving this presentation. I'd be gambling my life away in Vegas. And then for business owners here on the call, the pass-through entity tax deduction workaround, this was preserved, and this is a great workaround to the limit on the state and local income tax deductions. Unfortunately, Pennsylvania doesn't have this pass-through entity tax deduction, but just about all the states around Pennsylvania, New York, New Jersey, Delaware, Maryland, they have this, what is called the pass-through entity tax. So if you have a business that is generating income in other states, not in Pennsylvania, and you have a tax liability in those states, what this allows you to do is to pay the tax and get a deduction for that tax at the entity level. And then you ultimately pass a credit through to the individual members or shareholders of that entity. And they're able to use that on their return when they have to pay tax in those particular states. So if you're not taking advantage of those opportunities, this is another discussion topic for you, your accountant. hopefully if your accounts, with Baum Smith and Clemens, which most of you are, you're taking advantage of this. But this is a great workaround for even the $40,000 deduction, because we do have a lot of clients that have significant liabilities in other states. So they're able to get the deduction for the tax at the entity level and then get the credit at the individual level. So it's a nice workaround for sure. Just a couple of things that we touched on already, planning points with medical deductions. There is a 7.5% AGI limitation. So your medical expenses have to be over 7.5% of your AGI before you're able to deduct them. So that's why there's different strategies with trying to reduce your AGI in years you have high medical. So there's a lot of planning that can be done with certain deductions. So just keep that in mind as you're talking to your advisors. The qualified residential interest, it used to be $1 million. It was reduced to 750. So if you have a, acquisition debt of a home and your loan is below 750, all your interest is deductible. If you're over 750, you have to prorate your interest because not all of it is deductible. Insurance premiums, they're pretty common. We see them all the time. Those now qualify as residential interest. So you can pick that up as a deduction as well. As long as you're under the 750, if you're over, you got to prorate. And then the new tax law, they suspended the deduction for the home equity debt. They made that permanent. So if you have a home equity loan, before, if you had a home equity loan, no matter what you did with it, you were able to write off the interest. Now you really can't, but you do have the opportunity. If you do take out a home equity loan and it's secured by your main home or your second home, and you actually do renovations to your home, build an addition or do whatever, as long as it's to your home and the loan is secured by your home, you can deduct that interest. But if you take a home equity loan out to buy a car, to pay for education, that interest is not deductible. Some things on contributions here, just a general background. Your adjusted gross income, we always refer to it as AGI. So AGI is adjusted gross income. Typically in any given year, if it's a qualified charity, you can deduct up to 60% of your AGI in charitable contributions. So those who are charitably inclined, the higher your income, the more you can give away. If you can't take it as a deduction because of your AGI limitation at 60%, it'll carry forward for the next 5 years. So, if you do give money away, make sure you have a plan in place to be able to make sure you benefit from the deduction. 30% of your AGI for cash and other property, to 50% charities. Those are generally your more common, like your church and other 501c3 organizations. If you do have things like private foundations, your AGI limits are decreased on what you can give to the private foundations on an annual basis. So if you're a big giver and you have a private foundation, you have to do a little bit of different planning because your AGI limitations are reduced if you're donating to a private foundation. And that's what this 30% of the AGI is. What a lot of people don't capitalize on is this next topic of the long-term capital gain property. The logic behind this is if you give long-term capital gain property to a charity, so let's just say I have, I don't know what stocks are doing good right now off the top of my head, but let's just say I have stock worth $100,000 and I have a basis of $10,000, and I want to give 100. Thank you, Mike. And I want to give $100,000 to my charity. So I have the option of giving $100,000 cash or my appreciated stock of $100,000. I can give the appreciated stock to the charity of $100,000. Then I can take my cash of $100,000 and buy that stock, essentially step up my basis, and I don't have to pay tax on my $90,000 gain because I gave away my appreciated property. So if you are inclined to charitable giving and you have a nice investment portfolio, think about donating appreciated stock because you do save on the capital gains there. There's a 30% limitation of your AGI that you can do to qualified charities. And then if you have a private foundation, you're limited to 20% of your AGI. So just a couple different strategies around charitable giving. This is new now with the new tax law beginning in 26. If you don't itemize, you're able to make contributions up to $1,000, $2,000 if you're married filing joint, and you get an above the line deduction. So the difference between an above the line deduction and just a regular itemized deduction is above the line deductions reduce your AGI. Regular itemized deductions are just deductions after your AGI. So it doesn't help. Below the line deductions don't help reduce your AGI. And then going forward, there's a 0.5 AGI floor for charitable giving starting in 26. So your giving has to be over 0.5 of your AGI before you're able to deduct it. Similar concept to the medical deduction. It's just a 0.5% of your AGI. So I don't quite know who came up with the 0.5%. Seems kind of ridiculous, but it is what it is. Planning. This is what we just talked about, gifting appreciated securities. So just wanted to touch base on that again. And we talked about the repurchase strategy as well. If you still like the holding, you can repurchase it. But, if you are giving to charities and you do have a portfolio, really consider the appreciated stock approach. It's a great planning tool. Qualified charitable distributions. So these are contributions that are made directly from your IRA. And I don't think we see this enough as we probably should. With the increase in the standard deduction, a lot of people are not able to itemize anymore going forward, but they still are charitably inclined. So if you are above 70 and a half, you have to take your RMDs and you give to charity, you should be doing these charitable or qualified charitable distributions instead of just giving the money directly to charity, because you're going to be reducing your AGI. So it's another way to reduce your tax bill because you can't itemize the charitable contributions. So if you don't itemize, you're over 70 and a half and you give to charity, pretty much every contribution you should make should come from your IRA because you're going to be reducing your taxable income. So another strategy to talk about with your accountant, but we don't see this utilized as much as we probably should. So just something to keep in mind going forward. Another charitable deduction that we don't see probably as much as we should are the use of donor advised funds. They're probably one of the best vehicles you can donate to capitalize on a big deduction in a year where you need a big deduction, but you really don't have you really don't have a planned out charitable giving event. So you're able to donate money to these charitable donor advised funds, get a deduction, and then in subsequent years, you can work with the people who are managing the fund to give that money away. Now, obviously, in future years, you don't get a deduction when you give that money away, because you took the deduction in the year you put it into donor advised funds. But you can imagine, let's just say you're about to sell your business and you're going to have a huge capital gain event, and you have charitable giving in your mind. What you can do is make a large donation to a donor advised fund, even if you don't know where that money is going to go quite yet. So you're able to offset your gain on the sale of your business with this nice donor advised fund contribution. And then you can put a plan together to give that money away in subsequent years when your income's lower and you don't need those deductions. Private foundations, they're similar to donor advised funds, but they're more costly. There's an annual investment earnings tax on it. You have to give away a certain percentage, 5% a year of the assets that are in there. But the logic behind, if you put money in the private foundation, you get a deduction. There are AGI limitations like we discussed prior, but donor advised funds and private foundations are pretty common tools that are used. I think I see more private foundations than donor advised funds, but from the ease of things, donor advised funds are a lot less costly and easier to manage. You're just working with basically the investment advisor who handles the donor advised funds, whereas a private foundation, there's annual filings required, there's tax that you have to pay, and you do have to have a giving plan away because you have to give a certain percent of your assets away each year, which is this 5%, or you get penalized. So there's a lot more administrative and annual fees associated with private foundations. And then some other not so common things are charitable trusts. You can donate appreciated stock, business interest, or even just cash. You get you get an annuity back, and then when you ultimately pass away, the charity keeps the remainder of that. So you get a discounted deduction when you create the trust, and then obviously you get the annuity payments, and then in the end, the charity benefits and takes the remainder of the assets when you ultimately pass away. The child tax credit was increased from $2,000 to $2,200. This is going to be indexed for inflation each year. It starts to phase out at $200,000, 400 married filing joint, and $1,700 of it is refundable. So, we just got done talking a lot about deductions and above the line deductions and itemized deductions. These tax credits are a lot different than deductions because they offset your tax dollar for dollar. So in this last bullet point where $1,700 is refundable, you may have taxpayers with kids that have a zero tax liability. They're still able to claim the child tax credit. They won't get the full $2,200. They'll get a refund of $1,700, but they're still able to benefit there. And then there's another credit of $500 that was made permanent. That's been in play for years for other dependents. The child and dependent care credit, this is for people who have out-of-pocket costs for things like daycare or household employees to watch their kids. The percentage of the expense has increased to 50%. It starts to phase down, but you never go below 20%. Now, the credit's really nothing to write home about when you compare it to how much you pay for daycare or household employees, but it's at least something. You get a little bit of a benefit. What we don't see people capitalize on a lot, and what we don't see employers offer a lot, is this next bullet point, the dependent care assistance. It had been at $5,000. It was now increased to $7,500. But ultimately, if your employer has a dependent care plan benefit for its employees, what employees are able to do is put $7,500 aside tax-free as long as they use it for daycare. So it's a great opportunity. If you're an employer, it's very easy to implement. Most people have payroll companies. It's almost just a checkbox, and then you put an offering out to your employees. If you're an employee and you pay for daycare costs, it's something you should inquire about because your employer might have this plan and you're able to capitalize on it. So the tax savings on $7,500 is a lot more than the credit you get for the child independent care. So if you're able to capitalize on these plans, I would say, inquire about them and use them. The new tax law also allowed rollovers from qualified tuition plans, which are 529 plans, to able accounts. They made this permanent, and able accounts are essentially the same as a 529 account, but they're just they're geared toward disabled individuals. So we won't dive deep into that, but if you're involved with a disabled individual and you have interest in the able accounts, this is something to talk to your advisor about. What most people don't know too is that when you do prepare your tax return, your tax is calculated two ways. One mostly being the regular tax, and two, this alternative minimum tax. With the Tax Cuts and Jobs Act, they raised the AMT exemption and phase out, so it didn't really apply to a lot of people. Under the new tax law, the AMT exemptions went back down to 500,000 and $1 million. So if you're in that income range, 500,000 if you're single, $1 million if you're filing joint, you might run into some AMT issues where you haven't in the past. So it's just something to keep in mind. It's a sore subject, the AMT, because you have to calculate your tax two different ways. But if you get there, this is something your advisor will talk about, so we won't spend a whole lot of time on that. All right. At the end of 25, without the new tax law, the estate and gift limit was set to go back down to 5 million, increase for inflation. What the new tax law did was increase it to 15 million for single and 30 million for joint filers. So this was a big win for estate planning for people who are, in the 15 to or $30 million range from this. One thing to note here is the estate and lifetime gift exemption, they are coupled together. So for instance, if I have $15 million, which I don't, and I wanted to give that all to Mike today, I can give that to Mike. There's no tax, but I used my lifetime estate and gifting exclusion. So if I gift him that today and somehow between now and when I pass away, I make another $2 million, when I pass away, I'm going to have an estate tax on $2 million because I gave my $15 million away already. So you can either give it away during your lifetime or you can utilize it when you pass away. But, for people who are under this limit, it's still estate planning is still a good tax topic to talk about, to be able to shift, maybe some assets to different generations with different tax strategies. So even if you're under these things, the 15 and the 30 million, it's still a good topic to talk about. And then another random here, the moving expense deduction, the repeal was made permanent. There is an exception. If you're in the armed forces, you do get the moving deduction, but I'm all for the armed forces, so I support that deduction for them. All right, miscellaneous itemized deduction. So this basically related to, I would say the most common one would be W-2 employees where they're able to, write off supplies, mileage, other certain auto expenses. There's other, your tax prep fee, your advisor fees, those all fell under the miscellaneous itemized deductions. They took those away and they made them permanent. What they did change was for educators, prior to, well, currently for 25, and this had been law prior, you're able to take an above the line deduction of $300 for, any out of pocket educator expenses you had, for supplies, classroom stuff. What they did change is going forward in 2026, you are allowed, and it's uncapped, a unreimbursed educator expense deduction if you itemize of whatever your out-of-pocket costs are. So this is just kind of a nice topic. So if you're a teacher or an educator, or if you know someone who's a teacher or an educator, let them know that, hey, they get some benefit if they itemize in future years, if they're out of pocket a lot of money for what they do. The overall itemized deduction limitation repeal was made permanent, but they did replace it with a new reduction of itemized. So basically what the new one is if you're in the top tax bracket, your itemized deductions start to get eliminated. So so that's for people with over, $750,000 of income. Their itemized deductions will start to be limited. So if you're in that, that's just something to if you're in that, it's a good problem to have, but it's just something to consider, that you will be limited. Personal casualty losses were expanded to include state declared disasters. So basically now the only personal casualty loss you can take is if it's a federal disaster or if it's a state declared disaster. And, disasters are things like tornadoes, flooding, all sorts of stuff. We're in Pennsylvania. We don't have a whole lot of, weather issues here, but, places like Florida or the Midwest where tornadoes and hurricanes are more common. As long as it's a federally or state declared disaster, you're able to take a casualty loss on that. All right. This one is big for business owners. The qualified business income deduction, which essentially is you get a 20% deduction of your pass-through business income. And by pass-through, sole proprietors, LLCs, S corps, C corps are out of this. You get a 20% deduction on your bottom line income. So it's a huge, huge benefit to self-employed individuals. We work with a lot of our clients in planning to make sure we capitalize on this. If you aren't what they call a specialized service trade or business, which, the most common ones are accountants, attorneys, doctors, their qualified business income deduction is limited if their income starts to go over a certain level. But if you're not a specialized trade or business, you will get the deduction either way. Oh yeah, Hurricane Ida. We got a Hurricane Ida victim. So I apologize for the damage, but hopefully you capitalized on the casualty loss deduction. So back to the qualified business income deduction. If you're not a specialized service trade or business, you will get a deduction for it. If your income gets to a certain level, there's just different ways to calculate it. Now, we won't go down that route. It can be confusing, But just know that if you're not a specialized service trader business, you will get benefit from the deduction. So you should be talking about that with your advisor. All right. So a lot of the stuff we just talked about had been in play and basically all made permanent. So this is the next couple topics are new to the tax law. So we don't have a whole lot of guidance behind that, behind how this is all going to look just quite yet. One, because the government's been shut down for the last 45, 50 days. Uh, and two, the government, when new tax law is created, they just work slow as anything to get us the guidance behind it. So it always lags a little bit. Um, this new deduction is for tip income. Now, the tip income has to be reported to you. So if you are in an industry where you know you get tips and you report them to your employer reports them on your W-2, you will benefit from this deduction. So it's a $25,000 above the line deduction, up to $25,000. So if your tips are higher than that, you can only get a deduction for $25,000. So what this is basically going to look like is if you make $50,000 on your W-2, you're going to report your total income of $50,000, but then a couple lines down, you're going to be able to take a deduction for, let's just say your tip was 25,000 of that 50,000. You're going to get a deduction for that 25,000, and you're ultimately only going to pay tax. You're only going to pay income tax on $25,000. The entire tip income is still subject to FICA. And if you're married, you have to file joint to claim this deduction. Like I said, the income has to be reported. So if you're in a common industry where you get cash tips under the table and you haven't been reporting them to your employer, you haven't been reporting them on your tax return, you've already implemented this tax law way before it was in play. You're not taxing yourself on those tips. So, technically you're winning. But, if you know someone who is in a common industry, has tip income, they should be, making sure they're taking advantage of this deduction. There is gonna be a list provided by the IRS at some point in time, but really, it's your common industries where people get tipped. Your bartenders, your restaurants, your entertainment venues, even some service trades like plumbing, electrician. They're all on like the preliminary list. There will be a final list. It's just not out there yet. So once it's out there, we will circulate and educate everyone. But so if you get tip income, capitalize from this deduction. Another new deduction is the overtime deduction. So again, if you're in an industry where you get overtime pay, you will be able to capitalize on an above the line deduction of up to $25,000 if you file joint, 12,500 if you're single. There's phase outs with these two deductions. So if you make over 100,000, your above the line deduction gets reduced, but still it's a nice benefit for people who have lower income to take these deductions. Now, the one tricky thing with this deduction is for 2025, the IRS basically came out and said, we're not going to change the way we report their income on the W-2s. So if you are in an industry where you do get overtime, when you go to prepare your tax return or send in your documentation, your W-2 is not going to have enough information to be able to claim this deduction. So just keep that in mind. Most oftentimes your your last pay stub of the year has your overtime allocation on it. So that's something you're going to need to track down because your W-2 won't have that additional information. For 26, it's supposed to have to be reported by your employer, ultimately the payroll companies, but just keep that in mind. And again, if you're married, you have to file joint to get benefit from this deduction. If you file separately, this deduction doesn't exist. The senior deduction. I know I saw on the attendance list there was a question around Social Security taxability. I know when both sides of the campaign were going on last year, they both made a play to eliminate tax on Social Security. That did not happen. There has been no change to the tax on Social Security. So basically, if you get Social Security and your other income is, in the $30,000 to $40,000 range, your Social Security is fully taxable. And by fully taxable, 85% of what you get is taxable. What is new is above the line deduction for individuals over 65 years old. There's an additional deduction that you get of $6,000. Now, notice it does phase out at a relatively low level for married filing jointly at 150,000. So even if you don't take Social Security at 65, you still benefit from this deduction. So it's some say that this was the trade-off, that since they're still taxing Social Security, this is the new deduction you're going to get against it. Even if you don't take Social Security, you still get this $6,000 deduction, but there has been no change to the taxability of your Social Security. And if I were a gambling man, I probably would say that's never going to change. I mean, that's a pretty defunct program to begin with. Another new change is the above the line deduction for auto loan interest incurred after the end of 24. So this is for new auto loans. It could be a new or used car. It's got to be a new loan that happens, basically in 2025 through 12/31/28. It's got to be a new loan, and you're limited to $10,000. Oh, it isn't used vehicles. Sorry, it's just new vehicles. And the final assembly has to be in the United States. So I assume that there's going to be a VIN number database out there that'll be able to tell us where the final assembly was to just confirm that we can take the deduction. But again, it's for new auto loans for new vehicles. So I apologize about that use. I was thinking about something else. All right. Another new thing are these new accounts called Trump accounts. And I see Mike smiling. Basically, these accounts were created to encourage savings for individuals under 18, so for children. These are new starting in 2026. You're capped at being able to contribute $5,000 per year. Employers can put money into these up to $2,500. You can put money in until the beneficiary turns 18. There's no earned income requirement for these, like there would be with an IRA or a Roth IRA. And if you have a kid between 25 and 28, the government is going to put an initial contribution of $1,000 in these accounts for you. The key takeaway here is, from a tax planning standpoint, is this probably would be one of my last options if I have kids under the age of 18 and I want to put tax efficient money away for them. I know a lot of people on this call have kids, some probably over the age of 18, but at some point in time, there's probably a lot that have them and they're under the age of 18. So I'm not aware of anyone in the world that, was in the hospital, they have this newborn baby, they're so excited, and they hold the baby up and go, well, this damn thing isn't going to college. I highly doubt that has ever happened. So when you're thinking about putting money away for children under the age of 18, I think my first recommendation would probably be to start with a 529 account. What essentially those accounts do is you're able to put money away. It grows tax-free. And if you use it for education, it comes out tax-free as well. With these Trump accounts, whatever money you put in, when you take your money out, it doesn't get taxed. But all the growth in the account, the government one-time contribution, when you take that money out, that becomes taxable income to the beneficiary of that account. So there are other more tax-efficient strategies that you can use. Another example here is for business owners or individuals who have kids that have part-time jobs. Business owners, typically, let's say business owner is in the 24 or 32% tax bracket, and they have kids that are able to do some sort of function for their business. A nice strategy would be to put those kids on payroll, give them earned income. The business owner, which would be you, gets a deduction at the 24 or 32% tax rate. Your child will pay no tax because you're going to probably pay them underneath the standard deduction. So you're obviously shifting income from a 24 to 32% bracket down to a 0% bracket. And then what that does is create earned income for your children. And when they have earned income, and their income's as low as it is, you can put money in Roth IRAs for them. That's another strategy I think I would explore before I put money into these Trump accounts. I think once you maximize, your 529s, your other tax elimination strategies where you have 100% tax-free growth, then you might want to consider these Trump accounts. But like I said, if you're really interested in putting money away for children under the age of 18, I would talk with your accountant, even your financial advisor, to make sure you have the correct strategy, because there are more income tax efficient strategies than the Trump accounts. Now, if you're just interested in the $1,000, free government contribution, call your spouse and make arrangements to have a kid between 25 and 28 and get your $1,000. Just know that, side note, if you do have kids, they cost way more than $1,000. So I don't think I'd make that my, plan to have a baby. And when you take that money out, it will be taxed. So just keep all that in mind as you're going through. So just some different planning strategies. And just a couple more facts. When the beneficiary turns 18, these things basically become IRAs. They can be used for education, opening a business, purchasing a home. So it's all to benefit and encourage savings. But like I said, there are more tax efficient strategies to explore before you start dumping money into these Trump accounts. Long-term capital gains, under the new tax law, they didn't make any changes. So pretty favorable. The most common two things that get taxed at capital gain rates are qualified dividends and obviously long-term capital gains. You can see you pay 0% if you're in these tax bracket and your income is under these levels. If you have capital gains, you're going to pay 0%. You pay 15% up to a certain level. And then if your income obviously is higher, you will pay 20%. Now, another thing to note is there is an additional tax if your income's basically over 250,000. It's called the net investment income tax. So on top of these rates, typically if your income is, over 250 and you have capital gains or any other type of investment income, you are paying additional 3.8% on that. So that's where common strategies like your IRA qualified charitable contribution to be able to reduce your AGI helps reduce these additional surtaxes that come into play. But it's all part of, tax planning when you're working with your accountant. And then just a quick side note, if you do have short-term capital gains, those are taxed at ordinary rates. But short-term and long-term capital gains can offset with each other. So there is some planning there, with some short-term strategies. But if you do have short-term gains, you're going to pay ordinary rates on those. Some other things to consider about capital gains planning. Your deductions offset your other income first, which is very nice. So when you have capital gains tax, it's very favorable to the taxpayer. So if you have investment portfolios that kick off a lot of capital gains or a lot of qualified dividends, those are looked at very, very favorably. Sorry, I'm just admitting they're a little bit late, but it is what it is. And then another thing to consider is the principal residence sale. Not a whole lot of people realize this, but if you have lived in a home for the last 5 years and you sell it and it's highly appreciated, if you're single, you get a $250,000 gain exclusion. Married, you get a $500,000 gain exclusion. So it's just something to keep in mind. There's a little bit of planning involved. If you're jumping from house to house, you want to make sure you qualify for the gain exclusions if you do have, appreciation on those assets. And we also do encourage people to keep track of any big home improvements, additions that they do, because it increases your cost basis and ultimately reduces your gain and, most likely makes you eligible for a full gain exclusion. We touched base on the net investment income tax. We touched base on the 0% threshold for capital gains if you're under certain income levels. And then just note too, there was no change to the wash loss rules. So, If you sell a holding at a loss and you repurchase it 30 days prior or 30 days before, you can't deduct that loss.